So you want to invest in one of the best performing and most famous ETFs in the world, the NASDAQ 100, the home of all the big tech corporations and other innovative companies investors love. It's understandable why you would want to do that. This ETF has been dominating the markets over the past 2 decades and is loved by investors. But the problem is that you live in the European Union, and although you can enjoy the wine of southern France, the beaches of Greece or the Italian Alps without even having a passport, you cannot buy American ETFs due to the EU regulations. If you go to your broker and type in QQQ, the ticker symbol of the famous USA NASDAQ 100 ETF, your purchase will be denied. However, you don't need to worry, because in this video I will show you how you can invest in QQQ, or the European version of it, in a very straightforward and no-brainer way. So now let's go to my computer screen. Alright, now let's go to my preferred tool when it comes to researching European ETFs, just ETFs.com. When we land on the homepage, we go to the ETF screener, and this is where we're gonna be searching for the ETFs that we want to invest in. Regardless of what you want to do, here are all of them. Now, alternatively, you can search directly. Let me show you. You can search directly here, for example, NASDAQ 100. And the results are gonna look a little bit weird. So that's why I went to the screener first. But regardless, you click here, show all results, and this is what you're going to see. Now, it's very important for you to choose the proper country. So from here, from my profile, now I don't have an account with them. You might have, but I don't. You can choose the country and the language. So I have found out that the majority of the ETFs are listed for Germany, France, and the Netherlands. So if you pick each of these countries, you're probably going to have the most access to ETFs. I usually pick Germany. I think Germany or France are fine. And then you pick your language. All right. So what we're going to do is we're going to include a couple of filters. So the first thing is that I don't want my ETFs to be smaller than 100 million. It's just a safety measure that I use, because if they're smaller, then there is a better chance of them getting closed, which is, I'm not going to get into this video of what it leads to, but you're going to get your money back, but it's a hassle. So we click that. And then we go to the replication method and we pick full replication. That means that the ETF is actually buying the securities. Swap-based means that there are complicated contracts that are going on, which I don't have time to explain right now. But basically, the ETF doesn't own the securities. Now, that doesn't mean that it's dangerous or that you're going to lose your money, but it's just a layer of complexity added on top, which I prefer not to have. And then the last thing is I want them to be unhedged. Unhedged means that there isn't going to be any interference with the currency fluctuations, meaning that obviously NASDAQ is mainly USA ETF, 95+% of the companies are in the US, and the currency of the fund is going to be USD. And so the performance is going to reflect also the performance of the USD. And so if you don't want to take that currency risk, then you do currency hedges, but then that complicates stuff. And I don't know of any investor that I have spoken with that likes the currency hedges and have seen a lot of great results with them. And I prefer to simply go with the native currency of the companies or the ETFs, regardless of whether we're talking about individual companies or ETFs, because as I said about the replication method, I don't like adding complications on top of complications and different layers of complexities. And the growth of the ETF, especially when we're talking about the NASDAQ, if it is anything like the last 20 years, is going to dwarf any type of losses that you have because of the currency fluctuations. So I'm going to choose unhedged. And then that leaves us with 7 results. Now, in order to get these columns, I have preset them. But what you do is select columns and you choose fund size. This is total expense ratio, basically the fees. And then we click here to include the 1-year, 3-year, and 5-year return and the current dividend yield. And the result is this. So I'm going to start going through the ETFs in order of their size. You see, if you click here, you can order them according to size. You can order them according to expense ratio, whatever you want. I'm just going to order them based on size, and I'm going to start going through them one by one in order to see what the differences between these 7 ETFs that follow the NASDAQ 100 are. So first is the iShares NASDAQ 100 UCITS ETF. iShares means that it's owned by BlackRock. The total expense ratio is 0.33%. So as you can see, it is the most expensive one, and it's also the biggest. Now, I'm not going to focus a lot, at least, on the holdings because they are the same. I mean, it's the same ETF following the same index. But what we need to see here is that the ETF follows a accumulation policy, meaning that it reinvests any dividends that it gets. It does not distribute them to you. It is also 12 billion and 735 million euros, which is pretty big for European standards, at least. We also see here where it is domiciled. So it's in Ireland. And we can see the previous metrics that we already discussed. So the size, the total expense ratio, the fund currency, they're all going to be USD. So you don't need to check that. And also the currency unhedged that we chose. So nothing really special here. Let's go to the next one. It is the Invesco EQQQ NASDAQ 100 UCITS ETF. If you can see here, it has an yield, which means that it distributes the dividend. And this is something that differentiates it from almost all other NASDAQ 100 ETFs. So if you want to get the dividend from the ETF, regardless of how small it is, then you might want to choose this one. The expense ratio is close to the BlackRock one. It is 0.3%. Nothing special here to discuss. It is the second biggest in terms of size. And the dividend is currently, we have to change it here to dollars because it's going to distribute dollars. And the dividend is currently 0.42%. Nothing special, but you probably don't expect high dividend income from your NASDAQ ETF. So this is regarding this EQQQ NASDAQ 100. By the way, since I'm talking about European ETFs, if you want to see my top 4 stocks and ETFs for the current environment we are in, you can get the free report in the link in the description. It will always be up to date regardless of when you are watching this because I'm constantly updating it. Currently, one of the ETFs there is a European-based ETF, and I also have 2 individual companies in the USA and 1 from Canada. Then we also have another BlackRock ETF, but this one is domiciled in Germany and has slightly lower fee than the one domiciled in Ireland. I have no idea why they have done this, but if you want your ETF to be domiciled in Germany, maybe you have some preferential tax treatment between your country and Germany. Maybe you are German, I don't know. And so apart from being in Germany, the other thing that differentiates it from the other BlackRock ETF is that it distributes its dividend. It is one of the 2 NASDAQ ETF that alongside this one of Invesco, which distributes its dividend. So as you can see, if we go to the dividends and we have to change it to USD, it is 0.33%. Again, nothing to write home about, but you wouldn't expect otherwise from NASDAQ. So if you want a little bit of a higher yield, then you might want to go with the Invesco one. I'm not sure why the yield is different, but it doesn't really matter. So whatever you choose. Now the next one is the Invesco EQQQ accumulating ETFs. So it's basically like the BlackRock one, but it's owned by Invesco. And there isn't much of a difference apart from the fact that it has slightly less total expense ratio. And that's it. Again, it's accumulating and it follows the full replication as all the other ETFs. Now, the next one is interesting because it is the Invesco, again, NASDAQ 100 ESG UCITS ETF. So let's see what actually is going on with this ETF because I expect it to be a little bit different. Now, if we look at the performance here, the ESG ETF, it doesn't have even 3 years of history, so we can't really compare it. I don't think it's very useful to have only 1 year worth of performance. But what I don't like is that we have a morality filter layered on top of our investments. Now, what ESG means is environmental, social, and corporate governance. It is basically kind of morality attached to the investment. And if we go to the holdings, we will see what I'm talking about. So here you can see the top 10 companies in the fund. Now, I want you to notice something. If we go to any of the other ETFs, we can see Microsoft, Apple, Nvidia, Amazon, Broadcom, Meta, Alphabet, Tesla, Costco, and 87654%, etc. Now, if you go to Invesco, it's gonna be the same. Microsoft, Apple, Nvidia, etc. 87655%. It's the same everywhere because it's obviously the same ETF. Again, Microsoft, Apple, Nvidia, Amazon, 8765. But we go here, the percentage of Microsoft is changed, the percentage of Apple, Nvidia, all the percentages are changed. And we can see that here, instead of Amazon on 4th place, we have Broadcom, and then we have Amazon. Now, is that a big deal? I don't know. You decide for yourself. But I don't like the fact that they're deviating from the main index, which follows the NASDAQ 100. And then, if we go down, we can see that things start getting different. For example, we don't see AMD or Lint here, and we have them here after Amazon at 2.5 and 2.4%. And then we have Netflix at 10th place, which we also don't have in the top 10 here, where the 9th and the 10th are Tesla and Costco. So basically what happens here is that the ESG criteria is shuffling around the companies. And I personally don't like that at all because I have no visibility over what's going on. And I generally don't like moral filters being layered on top of my investments. Now, I don't want to really get political here in this video, but again, well, it's my video, so why not? The issue with ESG is that it tries to transfer the responsibility of things like taking care of nature, minorities, and social issues to corporations. My view is that corporations exist to provide profit for their shareholders and in the process distribute capital to the places in the economy where it is needed through the public markets, which is what stocks do basically. The saving of the penguins or the forests or the rights of women are important, but it's not the corporation's job to look after them. It's the non-profit and the governments that should do it. Don't get me wrong, I love penguins. Who doesn't? And forests, and I definitely love women, and I want only the best for them, but I don't want arbitrary moral filters to mess with my investment returns. These issues should be solved on societal and legislative level, not the corporate one. And so, if a company is legally operating in the markets, and there is no way it can be illegal if it is on the stock market, then that means we as a society and the lawmakers have decided that it's okay for that activity to be done, and this should be enough for everyone. Okay, I'm done with the rant. Now let's go back to the NASDAQ ETFs. All right, we're back here to the screen, and the next one is the AXA IM Nasdaq 100 UCITS ETF. And the thing that we can see here is, of course, it's smaller than the other ones, but it has the lowest expense ratio out of all of them. It's only 0.14. Now, the performance, as you can see here, actually it is, you can see a 5-year or 3-year performance because it's obviously less than 3 years old. The ETFs, we can see here how old it is. It has been founded on November 16, 2022. So it is basically a very, very young ETF, and it is managed by a fund manager that honestly I haven't heard before, and I would like to check before I invest in their ETF. Now, there isn't a lot of things that can happen if this ETF has been approved in the European Union. Obviously, there is a lot of scrutiny and there are a lot of authorities that make sure that your investments are safe. But nonetheless, just for additional peace of mind, that's maybe my conservatism and pessimism talking. I like to know what the fund provider does and where they are domiciled, etc. And since I haven't heard about AXA, I will check them. And fortunately for you, I have found a great source where we can see asset managers and a pretty reputable evaluation of them. It is Morningstar Asset Management Company's website. And here, all the asset managers are listed in alphabetic order. And what we see here is AXA doesn't even exist. And so to me, that brings a red flag. Now, again, we can check the company. And obviously I did that before recording the video. And I saw that it's a French insurance company. So it's probably properly regulated. But again, just to be super cautious, I personally don't like the fact that it doesn't even have any type of evaluation on them. And then the last one is Xtrackers NASDAQ, which is the smallest one at 683 euros at the time of recording this. It has the second lowest expense ratio, as you can see right here, if we sort them. So here is the Xtrackers version. Now I know Xtrackers. I don't know them as much. They're not as big and as famous as BlackRock and Invesco or Vanguard, Fidelity, and all the other ones. But I've seen other ETFs, and obviously it's the same ETFs, but we can see here that it has only 0.2% total expense ratio. And if we look at the performance, the Xtrackers NASDAQ has the highest performance for the 3-year period, if we sort it. And it's only by a little, obviously, but it's probably because of the fee, because there is no difference in the underlying companies and the underlying ETF. So it's probably just because of the total expense ratio. So after a long enough time frame, it makes a difference, but I still want to see what Morningstar tells about Xtrackers. So we can go down and search for them. And let's see what their evaluation is. So the first thing we see is not good. So it's basically run by WS company, and it's been under heavy scrutiny from SEC and German authorities regarding greenwashing allegations. All right, so that's not that serious actually. Greenwashing means, basically, we already talked about ESG. So it means that you are pretending to be very concerned about all of the environmental and social issues, but you only do it in your marketing and don't actually apply it in your funds and management of companies or investments. And so, I mean, it's not like BlackRock doesn't do it or Vanguard or all of them do it, but for some reason there have been scandals with Xtrackers. I wouldn't worry too much about that because, as I said, I don't really care about ESG. So let's go down and see something else. So here we see questionable and unsteady leadership has contributed to WS woes. And the conclusion is that at this stage, we continue to believe that the WS strengths justify a parent pillar rating of average, despite several weaknesses in its stewardship practices. So, I mean, it's fine. I probably would want to stick with Invesco and BlackRock because, as you can see, for 3 years, the difference is just a little less than 0.4%. So that's not that much. So if we go back and search for BlackRock, which is the owner of the iShares fund, and we're going to open it in a new tab and then search for Invesco and open it in a new tab as well. So as we can see, BlackRock has above average rating, as I would expect. It doesn't have anything to make us worry about the safety of our investments. Let's go to Invesco. Invesco has average rating, and let's see the conclusion. The picture outside the United States is mixed. The fund performance. So basically nothing to worry about. Morningstar says that they don't offer the most compelling investment options, but it's not like we actually care, because if they offer the ETF that we want to invest in, then that's fine. And as long as there isn't anything shady going on, I really don't care. So now that you have that information, what should you do? Obviously, if you want the safety and comfort of the biggest possible ETF, then you will go with the iShares NASDAQ 100 ETF. It is over 12 billion euros in size, and it is owned by the biggest asset manager in the world, BlackRock. It is the most expensive one in terms of total expense ratio, or fees, at 0.33%, but the difference between it and the other ones is not that big, and if it does make you sleep better, then you should probably take this ETF. Another good option for accumulating ETF, meaning that you won't be receiving the dividends, but they will be reinvested automatically, is the Invesco accumulating one, which is also pretty big at almost 2 billion euros and is run by one of the most famous and reputable asset managers in the world. Now, if I was choosing this ETF for my personal portfolio, because I love dividends and I am a passive income investor at heart, I will probably go with the Invesco EQQQ NASDAQ 100 distributing ETF. It is pretty large at over 6 billion euros, and at the same time it pays out a dividend of currently 0.42%. Now, it's not the biggest dividend, obviously, but as I said before, you wouldn't expect that from a NASDAQ ETF. The reason why I would choose that is more psychological than mathematical. And as I have said before, investing is not only mathematics, but it is as much psychology as math. I like to have what I call anchoring, with cash flow coming to me, meaning when I own an asset that pays me even if it goes down in price because there is a market downturn, then it helps me sleep easier, and it also makes me not feel like a total loser for holding something that is in the red for 1 or 2 or 3 years. For example, if we have a market downturn like in 2022 when the Nasdaq was down with more than 30%, then in that case, even if I have a minimal dividend from the ETF coming in every month, it will probably make it easier on my psychology. Now, again, this is not going to affect the total returns, but it is important to me. You decide if it is important to you. Now, if you want to go with the absolute lowest possible fee, then obviously you choose between the AXA or the Xtrackers ETF. They're both pretty big, at least for European standards, at over 500 million euros, but the fact that I couldn't even find AXA on the Morningstar website worries me a bit. Now, it is an official listed ETF in Europe, and I'm 99% sure that nothing bad's gonna happen, but in order to save a few basis points, to me, it's just not worth the hassle. If I was adding a few percentages per year to my returns, then I will for sure go with it. But in this case, I just don't want to even have to think about that and go with an asset manager that is less famous and reputable and big, just to be able to add maybe a percentage on my return per 5 years or something like that. If you need help with your investing journey and you want to go deeper into my investing philosophy, then I invite you to join my free investing masterclass, for which you can find the link in the description. The masterclass has already been seen by thousands of people, and I have had overwhelmingly good feedback on it, so I'm sure it will be useful to you as well. I hope this video was helpful to you and you'll be able to pick the best version of the NASDAQ 100 ETF for you and your goals. If you want to check my video where I explain how European investors can search for different ETFs depending on the type of strategy and investor they are, then you can check this video that should have already appeared on your screen. I will see you there.